Absolutely catastrophic. That's how one famous Wall Street strategist described April's sell-off in the markets as the bears have reappeared in lower Manhattan. The S&P, NASDAQ, and Dow all finishing the month deep in the red, and the selling doesn't appear to be ending anytime soon. So what should investors do now? Hi, everyone. I'm Veronica Dudo, and this is Buy, Hold, Sell. To answer this question, let's bring in the traders, Tobin Smith, Todd Schoenberger, and Justin Wine from Aspen Wealth Management. All right, Toby, you seem to have a different approach. Why am I not surprised? So you think the markets still have room to move higher?
I don't know. Someone must have written something wrong in your teleprompter, young lady. No, not only do I not think they're lower, I mean, here's what's going up. 60% of our portfolio is energy related, and it's up 50%.
That's
we
a good
like
one.
that. 20% of our portfolio is short bonds via the TPT, which is a reverse ETF.
Yep.
That's up 22%. The rest of it's in cash, and we just started adding some stocks. I will mention later, but no, people are in denial. And it's not a river in Egypt.
You are making
not only
tons of money right now, Toby.
Yeah.
But I got to tell you, all of those things, especially the oil trade, I think is going to go down because you're banking on higher oil prices, and that's going to keep escalating those oil company stocks. But even we just saw that last week with Exxon, Chevron reporting. Those numbers are okay, but there's a lot of headwinds out there right now. And you have to wonder what else is going to happen when Joey B. and his crew in Washington decide to say, let's start talking windfall profits tax. Once that starts happening, those stocks are going lower.
Well, by the way, we don't own Exxon and Chevron for those exact points, is because they have huge issues. Let's not forget about the fact that the dollar is up almost 18% this year against other currencies.
Right.
So unfortunately, when they sell oil in pounds or whatever, and it comes back in dollars, they're getting a haircut on the dollar. So not all oil, not all energy is going up, but for U.S. centric, for North America centric, Canadian and United States, we don't have those problems.
Justin, jump in here.
Toby, I think that's great that you're doing so well in energy and holding cash, but I think we need to look out below and be prepared to buy some of this weakness. We have great companies down 20, 40, 50%. And I think it'd be a great time to spread out, broaden your portfolio, and give some clients an opportunity in technology and some of these fallen angels. Look at Apple. They reported a Goldilocks quarter. We can see $250 next year. I would step into Apple. I'd look at Amazon as well.
Yeah, but again, the world has changed, Justin, and listen, I've written 2 books on investing in stocks that have to do with tech stocks. Okay? I don't have anything against tech stocks. Yeah, I don't have anything against tech stocks. But the world changed when the Fed is starting to take the $6 trillion away, when they're starting to raise rates. Long duration stocks, which have longer term high growth, but they get discounted more, and that's what's happening now. I'm not even talking about the silly SPACs and the IPOs that should never happen, whatever. We have owned Microsoft, Apple. We used to own Amazon. We own, that's about it in the tech space for a long time. And we're not selling those because there's huge profits in it, right? I don't want to have, I don't want my clients paying, $1 billion in taxes. But we're selling options against it to generate income, but we're hedged at 100% by being short. And I'm a more active manager than you are, I bet. But I get paid to not own stocks. I get paid to make people money. I'm not a financial planner. I'm not running their all portfolios, et cetera.
All over.
They pay me, they pay me to get high income, and they pay me to not have them lose money. And we have never lost money in 19 years, and there's a reason for that. When the world changes, I change.
Toby, I got to tell you, though, I think the tech story is a great long-term story. It's one of those things where you end up buying the stock, just like you bought a pack of baseball cards, you throw them in your attic, 30 years from now, they'll be worth something. But right now, investors want to know what to do right now, and it's not looking good. The earnings that came out from Amazon, that was a cautionary tale, because they were expressing how high their overhead costs are. And you think about it. You go and you buy something at Amazon, you buy 5 items. It comes in 5 different boxes. It's just not practical for a company to continue that. That probably worked fine that worked just fine several years ago. Right now, it doesn't in this inflationary environment, and that's going to crush the stock.
Yeah, but Amazon is the living example of what's wrong with stock valuations right now. Because remember, we had almost 8 to 10 years worth of demand pulled forward for 2 years. We're getting into the third year of the pandemic, right? That's never happened before. So there's, their sales went up, et cetera, but those were one-time events. Those are, how many more new TVs can you buy? And so now they're getting hit in 3 ways. Inflation rates, they got to fill those trucks up with gas higher.
Yeah.
The people are, getting unionized, and they're advertising $18 an hour here with a $5,000 sign-on.
Yeah.
So they're in the worst possible place you could be. The only thing that keeps them going is they have the AWS cloud system, which is doing fantastic. But now the bad news is overcoming, and we're out of Amazon 6 months ago.
AWS,
and I wouldn't throw it into your card closet either.
Right. AWS was 80%, I think, of their profits in their last quarterly report. Going forward, it doesn't look good right now. And I think Amazon's actually going to be setting the tone for a lot of these tech companies. I know Facebook did fine, but Apple coming out, and they're actually saying because of supply chain issues, they're looking at a possible $8 billion hit to their bottom line. $8 billion with a B. That's huge because that's crushing for investors. It's crushing for the stock, and therefore you have to wonder what's going to happen down the line.
Now, we really saw a lot of the market volatility start, when the Fed decided to ramp up raising the interest rates. I mean, do you think that there could be calmer days ahead once they start rolling that out?
No.
No,
because here's what happens.
No way. Good question.
I've seen this movie, and I've lived this movie 4 times, all right?
4?
How does it end? What's going to happen, Toby?
Yeah, how does it end?
I'm talking from the late 70s, the late 80s, the late 90s,
1870s.
and 2000 now. So, right, 1870, exactly. That's why I have my suit on, from disco. I should be dancing.
Toby, you've seen this movie before. You know that it always ends higher, and we need to get through these difficult times and look ahead. So we know what's terrible. We know that the Fed is going to raise interest rates. We know we have an inflation problem. There's a war in Ukraine. We can count the headlines, but maybe it's time to begin thinking about what could go right. If 1 or 2 of these things break free, and if the Fed does raise rates, we may have the setup that we can feel confident that things may improve in the second half of the year. And that's when we want to begin positioning after these great declines.
Well, I would just quickly say, we're in Cold War 2.0. That's completely new ground. That's not like the old days. We have a trillion going out of the liquidity pool every year. We never had that. You can't compare the other times because of what the Fed did, because of the pandemic, because of this Cold War, 2.0. And we're in a super cycle, a commodity super cycle, just like we were in 2002 when we started buying energy stocks when China entered the market. This is a new paradigm. And using the old paradigm does not work until some of these pressures come down, in my opinion. And I'm up 50%, so I'm going to say that, so far my paradigm works. All
right, that's right. Geopolitics, a lot of new technology, and COVID, definitely new territory. Thanks, gentlemen. Yes. Several Wall Street economists are calling for a recession, and the question isn't if, it's when. Coming up after the break, we'll discuss if we're already in the middle of one and what you should do about it. Welcome back. This week, we received the first quarter GDP reading, and the number reported was a big disappointment at minus 1.4%. So, Todd, does this mean the recession has already started?
Yes. I mean, simple answer, it's yes. And I got to say, it's not looking good for the second quarter. If you think 1.4% was bad, it's going to get really ugly the second quarter, only because when you start looking at discretionary incomes right now, you see them evaporating with the stock market. People are not making as much. They can't keep up with inflation. And as a result, they're not spending money. And you know, Toby, you know that the majority of that GDP reading comes out of the consumer, out of the household budget, and it's not going to be there. I think this number, this second quarter, is going to be bad.
Well, I mean, bad. It's not sheepish, but look at just the reality. In the United States, we're part of a survey group that we survey households, and we have 60% of the households in the United States, the richest country in the world, are what's known as Alice households. They're asset light, they don't own stocks. They're income constrained because they get hourly wages, and they are employed, right? But yet the U.S. Fed says they're $400 to $600 away from being on the street because they don't have cash. And now those people are using credit cards. If you look at the credit card rates and usage, it was up ginormously in the first quarter of this year. And that reason was that the people didn't have the money and they're putting the gasoline and the food on the credit card. That is a downward spiral. Because once they max out there, they got no place to go. And that's when we really tighten up. So I agree with you that forget about the numbers right now. For all intents and purposes, after inflation, the United States is going to be and is probably in now a recession. And that's before we take interest rates up to the point that mortgages are 6%.
Yes.
And auto loans are 11%. Are you kidding me?
I know.
All right. Gentlemen, I think we need to keep some perspective here. What one quarter does not a trend make. And let's remember, balance sheets are still strong. Consumers are spending. Apple reported blowout orders. You can't keep up with the demand. So yes, the gasoline is biting into consumers. Energy prices are high. Inflation is coming. It's making things more difficult. But again, let's remember, we came off of at least a decade of great numbers. Balance sheets are strong. There's lots of money in the system. And we are still relatively accommodative.
So technically speaking, if this continues for a second quarter, you are in a recession, but do you think that there are other extenuating circumstances that maybe that wouldn't hold true?
No. Well, absolutely. There's a lot to worry about here. Absolutely. Yeah. But let's again, keep perspective. My customers are long-term investors. So we're not going to get too worried about a quarter. We're going to look to the future. We're going to buy these great companies on massive discounted prices here. And we're going to be very successful on a 12 and 24-month basis. We're excited about the opportunity.
Well, you know, the buy the dip, I love that. So buy the dip worked because the Fed was making financial assets go up in value, so we would have the wealth effect, so the economy would keep going. And then we plumbed another $3 trillion into the pandemic. That lasted for 10 years, and that's almost 100% correlated with stock markets going up. We're now reversing that. Justin, why would you assume that now that we're taking money out, we're raising cost of funds, and we have sticky inflation? Rents don't go down, salaries don't go down, mortgages don't go down. We have sticky inflation, and then on top of it, we have the Cold War 2.0, where we're taking 550 million people in Europe, and we're trying to get new gas and new oil and new fertilizer, et cetera. Oh, and by the way, food. Food is already the prices. We're long wheat and corn, and we're long fertilizer. Because the prices have just shambled. We're going to have food riots like we had in Egypt. Years ago.
Chaos.
All over. So in that world, I agree with you that when everybody thinks the world, the market sucks, I want to be a buyer. But I want to be a buyer at appropriate valuations to the new 2.0 world we're in. And right now, I'm not going to buy a great stock at 35 times their earnings when rates and all this is going on. I want to buy them down like Warren Buffett would.
Too many headwinds.
So Todd,
I'm Buffett, back to the future.
The last recession, 2008, 2009, called the Great Recession. How long do you think this one would last?
Great question. I got to tell you, I think it's going to last well into 2023. I look at all the headwinds that are out there and also the geopolitical risks that are out there. And you have so many headwinds right now, you cannot suspect that the United States economy is going to be able to recover at a rapid rate. And therefore, this recession is likely going to end up, it might even be considered Great Recession 2.0. And I think we really have to brace ourselves right now. It's best for investors to start taking cash, holding onto their money, looking for higher yielding savings accounts if they can, and just start stockpiling, because things are going to get ugly and it's going to get a little bit chaotic right now and very stressful.
Yeah, and let's not forget that yeah, go ahead.
I want to take another position on this, Todd, and suggest that I don't want to bet against the U.S. consumer. The consumer's always demonstrated an ability to find money to spend, to have the newest telephones, and do the things that they want to do. Balance sheets are strong, and they will find a way to buy the things that they want to buy. We also have all this money coming from cryptocurrencies and trading in this department here. I'm going to maintain there's a lot of money in this world, and it's going to find a new home.
Justin, is that the Titanic over your shoulder? It looks like the Titanic. That's the U.S. economy, baby. That's what's going to end up happening right now.
All right. Thanks, guys.
Todd,
go ahead, real fast.
Todd, put your tongue back in your cheek, all right? Okay.
Okay, recession talk is just the latest variable to whipsaw the market. Coming up next, we're going to dig into corporate earnings and discuss whether the future is as dire as many quarterly reports are telling us. Welcome back. Roughly half of the S&P 500 companies have reported their quarterly earnings, with the majority of them beating analyst expectations. What should be a bullish sign has quickly turned bearish, as most of these companies are giving us weak forward guidance. How are you addressing this issue with your clients, Justin?
It's a great question. I want to point out that this is a classic case of under-promise and over-deliver. I think that CFOs have learned that if they miss their estimates, they're going to get hung. Even in the instances like Apple reporting great quarters and slightly reduced expectations, they're down. So let's look ahead. Let's take it with a grain of salt. I think earnings are going to be good. There's enterprise spend, which has been demonstrated with AWS. Consumers have a balance sheet. Businesses have money to spend. They're going to keep on spending. So I want to allocate my resources to the companies that are the beneficiaries of these large corporate balance sheets. I think we're going to be okay.
Yeah, well, okay, I'll add to that. Now, I don't think we're going to be okay, and I'll tell you why. There's just way too many headwinds right now, and I think corporations are coming out during once they release their reports, their earnings reports for the quarter, then they're trying to give us some type of guidance for the future. And normally it would be a little bit optimistic, but there's just so much pessimism right now that's why we're seeing such a big sell-off in the stock market. April was brutal, and we can only suspect that will continue down the line. But I have to say, when you start looking at some companies like a Netflix, they saw 200,000 less subscribers, a net loss in subscriptions. That's not good. You have to wonder what that means for their future. But then you start seeing how some people, even in the tech space, they might be moving away from some of the tech companies. That's hurting their forward guidance. But then you see a company like Facebook that comes out and gives out some positive numbers. So there are some companies you could pick and choose where they are, but the majority of them right now, there's a big pessimistic tone, and it's not good.
Well, yeah. Well, let's not also forget. We owned, I should say, the global platform companies for 15 years. They had hockey stick growth, and a lot of the growth all of a sudden started to come outside the United States. The U.S. dollar is stronger against any currency in the world. And what's happening now is the headwind of when you take your foreign sales and you convert them back to dollars, you're losing margin. And so, on top of everything else, I'm not saying, running around like a chicken with my head cut off, but I know bond rates are going higher. So I'm short bonds. You can just do it with the TBT. It's an easy index. It's easy money. Number two, we have very high dividend paying stocks, mortgage REITs. We have, pipelines, heaven forbid.
REITs are great. REITs are great.
Yeah, and we have WP Carey, which owns all those stores you see, all those Carl's Jr.'s and all that stuff on the shopping, and they have inflation-adjusted rents. Their rents are going to be going up at the same rate of inflation.
Yeah.
So there's ways to play this. But we are in a new era. It is not the same thing. And that's what I think people are missing. It's because, remember, stocks used to sell at average in S&P for about 17 times earnings, et cetera. That's when interest rates were, 2 to 3%. We're going to have interest rates at 5 to 6%.
Yeah.
And those earnings are not worth as much. And so for me to be excited about stocks in general, as opposed to what we own, which are up 50%, have I said that 5 times? Yeah. Is that the other guys have to come back. They have to be, what we say in Wall Street is, be re-rated.
Yeah.
And trees don't grow to the moon, right? We have companies, et cetera. But beyond everything else, the manias are getting shook out. The ARCKK, the ARC, Kathy Woods are down a whole round trip in 2 years. The SPACs are all dead. Those stupid IPOs are dying. That's the market doing the work it should. It should get rid of those things. But we have a longer way to go to adjust the real companies that Justin likes, those companies, to a value.
My biggest concern, Toby, going forward though, my biggest concern is that when I hear companies talk about inflationary issues, they start speaking of supplies that are going to be more expensive, or a supply chain disruption, or even higher labor costs. When I see that, that means the prices for those goods and services go up. And the consumer right now is not going to be able to afford those goods and services. Take a look at the Starbucks. You can't get out of a Starbucks now without paying $8 for a drink. That's insane right now. That wasn't like that 6 months ago.
Scott, didn't you recommend that stock?
Oh, Toby's calling you out.
You're calling me out, and I'll tell you what, you're right, but I'm good. I got something in my predictions. You're going to love it, Toby, when I start talking about Starbucks. You're going to love it.
Yeah, we can save Starbucks for later, but demand is strong. I was just at an airport a few days ago, and the line was 40 deep at the airport to buy a $4 latte.
But that's travel, Justin. That's travel.
Right.
That's pent-up travel.
Great segue.
But that's not the whole economy.
Look at all of the pent-up demand to get out of the house and travel. Look at what Uber's going to do. Look at Marriott. Look at Airbnb. Look at the booking sites. People want to go somewhere, and they're going to find the money to do it. And that will fill in some of the holes that you're showing in these other names with inflation and supply chain problems.
Justin, do you think we're seeing a move from people
of the economy,
spending it in the retail sector to more, instead of buying things, wanting to have that trip, wanting to go away?
Veronica, that's absolutely right. We're tired of buying things. We already did that already, and that's why Amazon's earnings were down. People want experiences. They want services, and they're dying to get out and do it. And I tell you, never bet against the American consumer. They're going to find the money. They're going to get out and do things.
Well, I never bet against the top 25% of the economy who can do this. But look, we are long some travel. Love booking. I love live events. I mean, people are paying $800 to go see, Jay-Z do a backflip. We call this a get me the heck out of Dodge trade. And so Booking.com, Marriott. I'm not. Uber and Lyft are a whole different thing because they still don't make any money. But I totally agree. But those are niches, Justin. That's what I'm saying. There are niches. But to blindly buy the S&P 500 now,
absolutely not. Nobody wants to do that. No.
Okay. Give it the Heisman. Stay away.
No chance.
So we definitely saw volatility this week, especially with the earnings. Do we think we have to be concerned about mass layoffs?
Yes, absolutely. Robinhood announced 9% job cuts. And then you have
but that's
PayPal's
Robinhood.
closing their San Francisco store. You can say whatever you want, Toby. You can spin it any way you like. But you know as well as I do that when you have higher overhead costs for companies and you have weaker earnings, what do you think is going to happen? You're going to have layoffs. Start looking at jobless claims the second half of this year. They're going to start spiking higher because people are going to be out of work. It's not going to be good.
Yeah. Right, but we still have 10 million jobs available and only 5 million people available for those jobs.
Crappy
So,
jobs. Crappy jobs.
Well, hey.
What, they all going to work at the Burger King?
Hey, don't put that down. That's where I started, Jag. Now, look, the issue is going to be that all this is like a fist fight. This is, and yeah, some are going to lay off, some are going to, I can get a job, anybody can get a job at any grocery store, at any Amazon warehouse, at any other place. There's 5 million of those jobs.
There are.
We're going to have layoffs where people don't have pricing power or we're getting demand destruction. That you're absolutely right at.
Justin, final word?
Well, I think it might take a little while for people to adjust to the fact that they're not getting government checks every month, and those people will spend down their money. They're not making money in cryptocurrency. They're not making money on meme stocks anymore. They're going to have to go out and get a job. And if that means $15 or $17 an hour, they're going to be okay. They're going to have to go do it. And businesses need those employees to continue to deliver the goods that they want to do. So we are seeing wage inflation that's going to hurt the businesses, but people will have jobs and they'll be able to do the things that they want to do.
All right, excellent discussion, gentlemen. Coming up next, we discuss a corporate marriage that many on Wall Street are saying could be a game changer for a tech heavyweight. Welcome back to Buy, Hold, Sell. The Elon Musk hostile takeover of Twitter gave us a 21st century view of barbarians at the gate, but unlike the RJR Nabisco takeover of the 1980s, the Twitter board couldn't pass on such a tremendous premium for their passion project and sold out to Mr. Musk. Toby, you have shared alternative thoughts with your clients that many on Wall Street haven't considered. Would you mind sharing with our audience too?
Well, don't buy Twitter, number one. Number two, for instance, we have a position in Chinese stocks started yesterday, Chinese tech stocks, because Chinese tech stocks are the new tech stocks. The Chinese government has reversed their ridiculous regulations against them. They want to get the economy going since closing down half of the cities turned out to be not such a bright idea. And a KWEB is a ETF that owns these Chinese tech stocks, and that's something where the values are so low, Justin, that I can buy JD.com, which is essentially the Amazon of China. And I don't know if you've done a little math recently, China's a little bit bigger than the United States. And they, my gosh, I can buy it for a 4 PE. Even Charlie Munger, for crying out loud, Warren Buffett's fan, is buying this stuff, right? So that's one area where I see value. And then the other, issue, as I talked about, was these is REITs that have inflation clauses in them, like WP Carey and STOR, STOR. You can hide out in those and get paid very nice dividends. Right. I guess, so it's time to be creative. But we are in a new investment paradigm, and the old one is dead.
You know what I think, though, Toby?
FANG is dead.
I'm going to tell you, Toby, you're a smart guy, but you're not smart about Twitter. Twitter is definitely going to be a great investment, and that is what the future actually holds. I know what you're saying. It's going to be a private company, and that's great. And
it's being taken private by Elon Musk.
But
how can I invest in Twitter's?
But where it is now, you're looking at a $10 premium then. Why wouldn't you buy it? You'd be a fool not to. If
I don't understand the upside here. The stock closed at $49 and will get taken out at $54.20.
Great.
That's a 10% upside. If this merger doesn't go through, Twitter falls back down to $35
it's gonna
and you
go
lost 30%.
It's going through. This is a great story.
They have until October
I'm not
for it
impressed by a
to be a done
10%
deal.
gain. I don't know. I think there are easier ways to make money. This is risky.
10%. I'll tell you another one I'm going to talk about a little bit later. But there's a way for you to get a guaranteed 9.5% return with zero risk coming up for our predictions.
But hold on, though.
There are ways to do this.
Twitter's at 43 a share. Twitter's at 43 a share. If you're going to buy the stock at 54 a share, why wouldn't you just buy it now? That's why yesterday when the market sold off 1,000 points, or almost 1,000, Twitter was flatlined. It was actually up for most of the day and just sold off at the going into the close. Here's the thing, though. Every investor knows this. If you're just going to buy it, you just want easy money, this is the way to do it. And that deal is going to go through. Do you honest to God, Justin, think that Elon Musk is not going to see this thing through? He just sold $8 billion of his own Tesla stock. Nobody's doing that if they're just thinking this thing's not going to happen.
I want to believe you're right. I think it's a bit of a sideshow. I love Elon Musk and I'm excited for him. What I'm most concerned about is what's going to happen to Tesla shareholders. Elon's already demonstrated that he can work 18 hours a day to make all of his companies work. Does he have another 6 hours a day to run Twitter? Now he's got a target on his back. He's going to be a political target of the government and in public enemy number one. Washington Post, New York Times. Everybody's going to be gunning for him. I hope he can handle the pressure.
Toby?
We talked about this recently. If I was Mr. Musk, I would go to a subscription model with Twitter because that's what I think as a private business, you can reestablish it and then take it public again if you wanted to, but he doesn't care, right? But to change it to make it work, if you create layers of service that you pay for, I learned a long time ago in Marketing 101, I want to make people better off in ways they desire and will pay me for. And I guarantee you that there's a lot of people like me who would use more Twitter if I could get rid of all this stuff. I would pay $5 a month just not to get Todd's Twitter feed, to be honest with you. Okay?
Well, Musk has already said that, he wants to stop the bots. He wants to authenticate everyone. He wants Twitter to be the digital town square. Now, a lot can happen. If Twitter wants to go with another deal, probably not as good as Musk's, but they could. They still have until October.
Yeah, they do, and they could look.
Nobody's got the firepower that Musk has because he has a board of directors of one himself.
Yeah.
And again, at that valuation, it's sort of a pipsqueak next to the other guys. And by the way, Snap is another stock that I own. They have a flying drone camera. Now that rocks. I love that thing. That I can see growth in, and AR lenses and all this stuff. But Twitter's got no AR. It's got no lenses. It's got no flying drone. It's just got an egomaniac who's buying it.
Oh, come on.
And we would have had other offers. Trust me, I'm on the board of directors of multiple companies. When you get an offer, you shop it. All your brokers and lawyers shop it. If there was going to be a higher bid, he would, Twitter would have already gotten it.
Yeah,
and they ain't getting it.
I'm going to sit this one out. Best of luck, guys.
Thank you. So coming up after the break, we look into Russia's move to shut down gas to Poland and Bulgaria. But one of our traders doesn't believe these two countries will be the only ones left out in the cold. for watching. Buy, hold, sell. Russia's blackmail attempt to halt gas exports to Poland and Bulgaria because they refuse to pay for the commodity in rubles seems to be working. But Todd, you say Russia has an enviable business model that can't be broken. Explain.
Yeah, that's right, because they have the product. There is no competitor out there, and they can call all the shots. The fact that they're going to really blackmail two countries and say, look, you can't receive our natural gas unless you're paying in our currency. And some countries are actually falling for this. They're doing it because there's no other competition out there. Yeah. Unless the United States can go out and start drilling off of our shores and start shipping it over there, that's the only way that's going to salvage this. But you know as well as I do, Toby, that's not going to happen because the current Biden administration is not going to allow drilling off of our shores for natural gas. And that is a shame.
First off, we don't drill off our shores for natural gas. We drill for oil. And number two, we have the largest natural gas reserves in the world. Makes Russia look like a puny country in the Marcellus Shale, which is Pennsylvania,
we can heat
Ohio.
every home in the United States for 10 years, Toby, with all the natural gas, and we're not doing anything about it.
No, Todd, it would be 100 years. And number one. Number two, we can't get the pipelines. Remember, the one thing that we've had many cycles going over the last 5 years. One of the cycles been ESG investing, meaning environment, social, and governance. Right. And for big pension plans, that has meant that many of them have not been investing in large oil, in pipelines, et cetera, et cetera, et cetera. Well, now that's going to get reversed because natural gas is now a strategic asset to the world, to the West, to the world that is not Russia and is not China. So in Cold War 2.0, we got Russia, Iran, China on this side, and we got everybody else here. And that's why I believe, and I know you're a big Biden fan, Todd, but I honestly believe that this ESG investing is going to crash and burn when it comes to natural gas pipelines because they now know that it's their lack of investment in coal, in gas, and in oil that has now caused a situation where the whole world is a hostage, except if you're in North America.
Absolutely, Toby, and you're absolutely right that it's time for U.S. to have a firm energy policy. We've had a preview here of what could happen to Germany and China, and if they can't have the natural gas and oil that they need, then they're going to be in big trouble, and that will exacerbate supply problems. Let's hope that the midterm elections and what could be a clean sweep of the Senate and the House will give us some direction where we could get back to drilling, developing our own resources here in this country, and further solidifying our energy independence.
Yes.
We need to wake up now and get to work.
Germany and Italy, two other countries in Europe that are hugely dependent. I mean, what do you think the United States can do if they're not willing to try to start producing it domestically?
Well, this is the thing. Yeah, this is the thing I think people have missed. We're deep into the energy space. I've done it for 25 years. My wife's an oil geologist. All right. If we started drilling today, if we started drilling today, blind, but who cares? The entire world would not see a drop of natural gas or oil for another 9 to 12 months. One of the reasons is because the oil crash was so tough that we've lost a lot of jobs. There's not enough materials. The second thing people say we're going to do is, everything's going to be EV and everything's going to be electric vehicles and battery. But to make those electric vehicles and those batteries, we need strategic metals, of which we don't have any in the United States. We have some in Canada. So we just had solar energy as the result, and now we're seeing the solar panels are not being produced in anywhere near the number, and we have a tariff on it. So this problem is with us a lot longer. There's no magic answer to this.
Well, there isn't. However, we had it under Trump, though, and I know how much you love Trump there, Mr. Toby, but I got to tell you.
Oh, one of my favorite people.
But remember, Biden's first thing that he did right after the inauguration was he went right to the Oval Office and signed the executive order to tell the Interior Department to stop drilling on federal land and also look at all the other leases that were out there. And that's why we were actually a net exporter of oil. Now we're not. Now we're dependent again. And here's the thing, going forward, hold on, though. Going forward, you have to suspect that there has to be a clear change. Justin's right about Congress and having a change during the midterm elections, but there really has to be a change at the top. And that we're probably not going to see anything like that until at least 2024 to see if a Republican get into the White House.
That's right.
Well,
we need to clear up the bureaucracy.
Go ahead, Justin.
The Biden government is issuing more license to go out and do E&P, but we've got to clear up the bureaucracy so we can start putting holes in the ground and give your wife some more work to do. We need the oil out of the ground. We need to maintain our independence. And while the oil is a global market, price is established globally in dollars. We do need to support our own independence, and I think we can do that.
Yeah, let's just not forget that natural gas is the new oxygen. Natural gas solves almost every problem. It's just that we can't ramp it up. And right now we're at the point where coal is more affordable for most countries to burn for electrical power than natural gas is. So
and they don't have ESG concerns.
How are we better off? Yeah, right.
We're so full of ESG over here that we can't use any of our coal, and that's been difficult for the operations and all of our coal producers as well. So we do need some help on policy. I hope we'll get it soon.
All right, guys. Coming up next, we'll give you our investment predictions and maybe a few other surprises. All right, let's make some money. Predictions. Todd, start us off.
Okay, I love the Twitter story. I know we've been talking about it all show, but I think that this is easy money. This is easy money, Toby, and I gotta say, if you can buy it at 43 right now, and it's gonna be sold out and going private at 54, why wouldn't you take advantage of it? It's probably the only sure thing that's out there right now in a down market, so it's my pick of the day.
Toby, your buy?
No, I'm not, but I buy the options, actually, so I'm going to put a little bit of money up to see if Bonehead Schoenberger's right, but I'm not going to buy the stock, okay? That's just me. I like to make money. Hey, do you know that you can get 9.5% yield for the next year by buying a U.S. savings bond? You go online, and because of inflation, and it's 100% guaranteed by the federal government, which that may be another issue, but 9.5% for doing nothing. Now, for some of our new accounts, we put about 8% of their portfolio of their low risk stuff in these bonds, and they're fantastic. And you even get a little pretty bond, and you can take a picture with it.
Like it, I like that.
But you gotta be thinking outside the box here because the box is caving in.
Justin,
Toby, I'm gonna see your 9% in the savings bond and raise you 2%. And I'm going to tell you to look at BDCs. Look at FSK yielding 11 or 12%. Yeah. It's been super stable. It's a good cash alternative for some of your cash. It's not a sure thing, but I'm going to look at that. And I'm also going to look at Apple down to 138 and start nibbling there. I think Apple can be 250 in a year.
And by the way, we love BDCs, and we're long NEWT, Newt, which is another BDC that pays about a 12% yield. So I'm totally with you there.
Yeah, maybe dollar cost average on the Apple side because it's going to have more down quarters, and therefore you're going to be able to take advantage of that.
I hope
it's
so. I'm very excited about the opportunity.
Right, all right.
Todd, your hold?
All right.
Okay, I'm holding on to cash. I got to say, cash is king. Hold on to your cash. If you have any gains in the stock market right now, take advantage of it, liquidate, put the money in cash, try to find a higher yielding online savings account. Goldman Sachs has a good one. Capital One is another one. Have that money put in there, keep it there, let it collect some dust. You'll earn some interest, and you'll be much better off for it down the line.
Toby, your hold?
Yeah, it depends whether you have a taxable account or a non-taxable account. That's Justin's world, okay?
So boring, Toby. So boring.
Yeah, if I go to cash and then I wind up paying a bigger bill than I paid for last year, then I'd rather get dividends. But I'll tell you what my hold is I continue to hold the Devon Energy, these companies that have variable dividends. One thing that happened in the energy space is and shippers for that matter, SBLK, bulk shippers, is they're paying 50% of their cash flow in dividends. They used to pay 10% of their cash flow, but now they've had, a come to Jesus moment by, they used to just take their cash flow and buy more boats when then prices kept going like this for rates. So now they're not buying more boats, they're getting rid of their boats, and they're paying these high dividends. So I'm holding on to Star Bulk, on to Globus, on to GOGL, Golden. All of those shippers are paying me 14 to 25% yields.
Wow. That's a winner.
Justin, your hold?
Well, I want my investors to know themselves, and that means holding some more cash. So I want my clients to have 10 to 30% in cash. If they don't have it, they need to raise it, but I'm holding FANG. I do believe these companies are unassailable. They're dominant in their industries. They're going to be fine, and I want to be in the biggest companies that have the best supply chain access. And if you're not Apple, you're not going to get the chips. I'm worried about Ford. I'm worried about GM.
Are you still, in FANG, are you still holding Netflix?
Well, I nibbled on it a little bit, but let's see what happens. They have 100 million subscribers that aren't paying for the service. That's encouraging. If they monetize 25% of those, they have another 25% of revenue. I think that's encouraging.
I just dropped mine.
Yeah,
I'm not paying $21 a month for it.
Todd, your sell?
Okay, my sell. Okay, Toby, I have to admit I was wrong. I said you should buy Starbucks. It was not a good pick. The stock actually has been down a few dollars, right, since I recommended it. But I'm going to share this with you. I would sell Starbucks, sell it short. The stock's going to continue to go down because I don't believe that the average person going to a Starbucks is going to be able to afford an $8 latte. It just doesn't work that way. Maybe a few months ago it was $5. Now it's $8, and it's only going to continue going up. Plus, I think Starbucks has a huge management issue because of the unionization of some of their stores. Yeah. Baltimore, actually, my hometown, has some stores right now that are going to be voting to go union. And upstate New York, you see it as well. You're going to have more and more. You're going to have more and more of these stores going union. That's only going to elevate prices. It's also going to elevate prices of their drinks. That's a stock you want to stay away from right now if you can. Sell short or just don't invest in it at all. There's
a lot of home machines. You can really replicate those drinks doing it yourself if you have the time.
Good point.
Toby?
Yes. Well, I'm still selling the ARK funds, ARKK. Kathy Woods is a genius at finding disruptive companies, but she's not a genius at actually valuing them. And all those stocks went into a stock mania when every 20 and 30-year-old got their stimmy checks, and they were YOLO and FOMO and NOMO and GOMO buying all this stuff. And there's a term in investing called the marginal buyer. The marginal buyer is the person who is not price sensitive. And they were all marginal buyers. If you're at an art auction, the person who winds up with the picture of Schoenberger, the third, that person was the marginal buyer. They didn't care about, how worthless the painting was. So the whole idea here is that ARK is beyond anybody's imagination that they could go down. That's when I like to continue to be short these stocks.
And Justin, close us out.
Before I tell you what I'm selling, I'm going to buy Todd Starbucks. I think that people that are poor can afford cigarettes and coffee. They're simple pleasures. And if I can find $4 a day to buy a coffee, I'm going to feel better about my day.
Oh, no way. You might as well just go to Dunkin' Donuts then. You could get a nice coffee there for $2.50. There's
it's
no
not
way.
luxurious enough.
Oh,
I want to feel rich. I'm going to buy a coffee at
Feel
Starbucks.
rich. Why you want to be around a bunch of people worried about cancel culture and their woke environments and their all this and that? I don't want to hear any of it. I'd rather stay away from
the
it.
drive-through.
You know what? I'm going to save my money. I'm going to go to Dunkin' Donuts 4 times for every one of your trips to Starbucks. That's what I'm going to do.
People enjoy their handcrafted drinks. I mean,
but I will sell high PE, no growth, stratospheric earnings, stratospheric.
There you go, Justin. Now you're on the team. Now you're on the team. Unscrew you. I thought you were crazy first, but now I see it.
I'm with you.
All right, and that wraps up another week of Buy, Hold, Sell. Join us next week as we discuss the Fed's move to raise interest rates and analyze Friday's all-important jobs report. Have a great weekend, everybody.